All right, what's going on, everybody? We are back for Wealth Webinar Series number 3. So we've done Series 1, Series 2. This is the third one, and today we're going to actually get down and dirty, and we're going to show you how this entire concept that we've been talking about, how this actually can solve some real problems for you. And I bet you all of you at one point or another in the last year probably have thought about inflation. And you've probably thought about, what is inflation? Well, it's a hidden tax. You've also probably thought about, what is the impact of inflation on my money, my wealth, and my financial future? And you know what? That differs for everybody. But you know what? The best part about inflation is we can beat that son of a bitch. And that's what we're going to show you how to do. We're going to show you how to beat inflation. And I've got a little special thing I'm going to show you. And this is really neat. We're going to do a full YouTube video on this. But today I figured I'd kind of launch it out because it's a really interesting topic that plays right into the infinite banking concept. I'm going to show you how I just bought a Maserati for $8,782. And by the way, it's not used. It's brand new, has about 20 miles on it right now. So how many of you would want to buy a Maserati for $8,782? Well, I'm going to show you how I did it. And you can't do it by just walking into the Maserati dealer and say, hey, I just saw this video. This guy just bought this Levante for $8,700. Can I have one? They'll march you out with security guards and no coffee for you. But we are going to get into that. We're going to talk about that. And also, I am very, very proud of this. So I love Ray Dalio, and Ray Dalio talks a lot about portfolio design. So I am going to unleash the Kraken today and show you what I call the all seasons portfolio, which is a portfolio that can do a great job of keeping your money safe in difficult or even good market times, but also how this portfolio will allow you to be in control and move your money in a way that no other portfolio I've seen can do. So those are the topics we're going to cover. But Brent, we're going to dive into how we actually use these policies to beat inflation. And the fastest way is what I'm going to go over in this first slide. Some of you have seen this, some of you have not. So if this is a refresher, listen, sometimes you can't see this stuff too much. So everything Brent talked about was, where are you going to warehouse your wealth? Where is your money going to go first? Because remember, all we're doing here is adding one step or changing just one thing. That's all we're doing. We're changing one thing, and that's where your money goes first. So we're talking about putting it into a specially designed and engineered whole life plan. When we do that, we instantly turn on the uninterrupted compound interest, the guaranteed interest rate, the ability to be in control of our money, tax-free growth, and yes, a legacy play. But the legacy we already discussed isn't the most important thing. It's the money that you have to use. So when you change where your money goes first, and we put it here, what we want to do is figure out where it's going next. Too many people put too much time on the whole life. They think that that's the most important thing. They think, oh my God, the whole life. Oh my gosh, that's everything. Oh my God, the illustration. Oh my God, the design. It's an important thing because it's the machine that moves the money. But if you just want to put money into the whole life and not do anything, then you're probably in the wrong place. I mean, yes, it'll be better than your bank account. Yes, it'll be better than most other guaranteed accounts out there in terms of growth, but it is not going to be what we teach and what we tell you, because what we talk about is just everything you just saw what the insurance company does, and everything that the banks do is move money. So you got to move your money. And how we do that in this capacity is through loans. And we always talk about it, right? The loans right now are between 4 and 5%, depending on the company we use. And the guaranteed rate with dividend can be up to 6%. So I'm done kind of breaking it down, but up to 6% right now and into 2022, we just heard. So the rate could be up to 6%. So if we're making 6 and we're paying 5 or 4.75, we're making a spread. But that's only the first year, because remember, if you understand compound interest, each year, whatever you put in here, it's growing at this rate. And when you take the money out as a loan, you're not interrupting the flow of interest. So every year you're compounding on a higher amount over and over. So the spread, the 6 minus 4 or the 6 minus 5, every year gets bigger. It doesn't matter what you do. You're not working harder for that. So how we move that is, let's just look at all the things you do. Where does your money go today? Do any of you, or can any of you actually tell me where your money goes each and every month? Have you done a budget? Let's see it in the chat right now. I want to see how many of you actually have done a budget and you know every penny of where your money goes day in and day out. All right. So and yeah, thanks, Hannah. Where your money goes. So how many of you have a cell phone? Okay. All of you, right? How many of you finance your cell phone? Well, right now, if you finance your cell phone, and most of you probably have an Apple, I will tell you it's $60 to $100 a month. That's money that's going out of your household every day. How many of you drive a car? Okay. How much is your car payment? Well, depending on what you got, could be $500 a month. And whether it's a lease or whether it's actually financed, $500 a month is money that's going to somebody else. And it's at a rate of, I don't know, anywhere from 2 to, I mean, I've seen interest rates up to 10% on cars, depending on your credit. How many of you pay credit cards every month? You know, I know all of you have the best intentions to use your credit cards and then pay them off every month. But sometimes, you know, it just doesn't quite work that way because we make money and we spend money on things we don't need. So how many of you have a credit card? I bet you all of you. And I bet you all of you have a monthly credit card bill because you're not paying the balance off. And how much is your interest rate on those credit cards? For simple math, let's just use 20%. And I bet you a lot of you are closer to 30% for your credit cards. So when you figure it all out, all these different things, let's just pretend that you bought yourself one of those fancy gym things and it was whoops, not 100%, sorry, $100 a month, $100 a month. And that would be, I don't know, let's just say 8% interest. You see, when you figure out where your money goes, you can easily figure out how to start building wealth by not investing and taking risk, but by simply just taking back the money you're giving away. $100 there, $100 there, 500 here, 200 there. So what we do is we become the bank. With this specially designed and engineered whole life, we basically put the money in the policy, and it is designed completely different than a regular whole life. We take loans out. The segregated account is just a stopping place, because we can't move the money directly from your policy to pay your cell phone. We have to stop at a bank, like a real bank. And our goal with this real bank, this segregated bank account, is to get the money in there and out of there as quick as possible. Because remember, we don't want the bank making money on our money. We want to make that money. So we just move that money right through. And how you do it is depending on how much money you're funding your policy, we pick the lowest balance to the highest. Most of these, your lowest balance is usually going to be your cell phone. Once we pay your cell phone off with a loan from our bank instead of the loan from Apple or the loan from Samsung, we then have freed up $100. Okay, so you now have $100 that gets to ship back to your bank where you warehouse your wealth. And we just keep repeating this process. But now we got an extra $100 that you didn't have to work harder for. You just took back from Apple. So you got this 100 working for you, plus the money that you're putting in there. You just go down the line. Whatever this thing is, the treadmill, we'll just use that. The treadmill that you bought, now all of a sudden that's paid off. You take that money back. Okay, then we keep going down. The credit cards, you pay those off. That's $200 a month. And then you pay the car off. That's $500 a month. You see, all these things are money leaving your household, leaving your family forever. You'll never get it back. And all we're going to do is we're going to then become the bank, pay all these debts off in a systematic way, and then take that money and move it back into our policy. So for those of you that are worried about inflation, let me ask you a question. If we were to add all this up, I don't care even if your cell phone financing is 0%. Let's just pretend your car is 5. We'll do 5% for your car. So you got 25, 5, and then 8. All right. So if you guys do the math, that's 28, 29, 30, 31, 32, 33% interest combined. And then if we did an average, I need a calculator here. 1, 2, 3, 4. Sorry, folks. I just want to get this right because I know someone's going to be like, oh, dude can't even do math. I can do math. I have a calculator. So 33 divided by 5 means your average would be 6.6%. If I did the math right, usually Andrew or Joseph are in here doing the math for me, but 6.6% that you were giving away on an average. Imagine that. Now you just took this interest back. That's now going to you. That's on top of the spread. You just made money twice. How much is inflation right now? 6.2, 6.4, depending on what number you believe. Did we beat inflation? Yes. We beat it. We beat inflation just by taking back money you were giving away. And then we beat inflation also even more by the spread between the money you made and the money that you had to, the cost of the money, the interest you had to pay the insurance company. So right there, that's your first way. But, you know, I know a bunch of you on here are like, Chris, this is so boring. I don't have any debt. I'm already there. I don't have any debt. So if you're one of the lucky ones like Steve Bell here, who doesn't have debt, let's get to the fun shit. Let's talk about this. Do you have a business? How many of you own a business? Put it in the chat. I want to know how many of you right now own a business. Does Steve own a business? Who else owns a business here? Okay. We got some business owners. Who else? Dale's got a business. Okay, Theodore's got a business. Now, let me ask you, as you guys are chiming in on how many of you have a business, can you all tell me one thing? I want to know, does your business ever need money? Just put in I or yes, AYE or yes. Okay, Dale said yep. Dustin said yep. Oh, Jade said yep. Jade's got a big business. Big businesses and small businesses need money to operate. And if you don't have the money from cash flow, where are you going to get it? The bank. You're going to go to the bank or you're going to pull out your credit card. We all have done it when we own business. You need equipment, you need stuff, you got a big order you need to fill, you're short on payroll, you borrow money. So if we're talking about you being the warehouse of your wealth and we're talking about you being a good steward of your money, again, all we did here is we just changed where our money went first and we created our own bank. And now what we're going to do is we're going to take loans from our bank. So this is just a repeat, right? We got all this stuff figured out already. If anyone has, wants me to go back, just let me know. But I think you all understand we're putting the money in a specially designed and engineered whole life. And then we're taking that money out, sometimes immediately in the first 30 days. And then we're moving that money. Exact same thing the insurance company did, the exact same thing the bank did. But here, we're going to move that money to our business through a loan from us personally to our business. So I want to draw a big line right here. Okay. So sorry, it's not very thick, but that's the big line. That line is, this is you personally, and this is your business. For any of you that think you are your business and your business is you, you need to go back to business school and understand that your business is independent of you and you are independent of your business. You might own it, but you are not your business. Your business is its own entity, its own thing, and it operates on its own, basically two legs, if you will. So when we borrow money from our policy and our company needs money, we can then do the same thing that the bank does to you, and we can lend money to our bank. And the way that we would lend money to our bank would be through a loan. And all you're going to do is you're just going to create a note. And the cool thing about creating a note is it's easy. Okay, just do a promissory note. It's you to your business. I don't think you really need any collateral. So just promise to pay your business back. And how I do it, okay, I put 8% here, but I charge my business 6%. And I take loans all the time from my policies, from my banking policies, and I loan it to my company. And I charge my company 6%. I came up with the rate, and listen, you don't have to use my number, use your own number. But I used 6% for this reason. I have a good CPA. And I called him and I said, Mike, can we do this? Is this legal? He said, well, why wouldn't it be? I said, I don't know, because the government doesn't always like to make things legal that make sense. Sorry, Mr. IRS, but you don't. Anyway, so I said, and he said to me, he said, it's very simple. He said, if the insurance or if the IRS allows you to borrow from the bank, why would the IRS not allow you to lend your money or your business money? It's all the same thing. I said, so how much interest can I charge? He said, well, what's the bank charge you? I said, 6.99 on this one line of credit. He said, well, I don't know, charge yourself 6%. It's less than the bank. So if the IRS ever audits you, you can say, hey, it made economic sense. I was 1% cheaper than the bank was, and they're not going to ask questions. So I lend it at 6%. And I do a calculation. I can either pay interest only, or I can do, you're the bank. Here's the thing. People ask us all the time. They call Hannah and they call our mapping team all the time. And they say, well, what should I charge? And how should I pay myself back? And what if I can't pay myself? I say, you got to stop thinking that way. You're the bank. You make the terms. You set the rules. You're in control. You don't have to answer to anybody. You are the person at the top that you got to answer to. So pick your term, pick your rate, pick your payment. Doesn't matter. Your business, whatever it can afford, that's what you pay. So let's just say I take a loan from my policy for, I don't know, let's just use $10,000. And I'm going to run a marketing campaign for the private money club. So I lend $10,000 to my company for a marketing campaign. I charge 6%. Let's just say I want to pay $200 a month back. I then take this $200 and I pay it back to my policy. You see, all I'm doing is I'm creating a circle. Money goes into my bank, money comes back to my bank. It's just completing the circle. And now, again, let's do the math. We're talking about inflation. I charged my company 6% through this promissory note. And how much money was I making over here? Let's just assume 6%. Not all of you are going to be at 6. It depends on the company, but my policy is indeed 6%. So I'm making 6. Now, also, I want to be clear. I'm always making 6, but depending on what year I'm at in my policy, the policy just keeps making more and more. Remember Brent's business example? In the beginning, I'm losing money the first couple of years, but then after that, I'm making money and it makes money the rest of my life. So it depends on where I'm at. to determine what my spread is, but most of my policies are mature, except for the brand new ones. My newest one was just started, I think, this week. Actually, I know for a fact, Sarah just gave me the congratulations, your policy's approved, number 8. But you get the drift. Is 6% enough to beat inflation? It's pretty darn close, right? But 6 plus the 1%, if this was my brand new policy, is that enough to beat? Yes, it is. You got 7%. So now, just for doing things that I would normally do in my business day in and day out, I just beat inflation. Do you see, folks, this isn't complicated. All I'm doing, folks, in these examples is I'm moving my money. I'm doing the same damn thing the bank does day in and day out. You watch it happen. They give you your dumb sucker every time you make a deposit, and they don't even smile at you anymore. Enjoy your dumb sucker, because that's what you are, a dumb. You're not paying attention to what the bank's doing. You're literally just playing into the whole game that they told you was what you should do with money, and it isn't what you should do with money. That isn't going to beat inflation. This is going to beat inflation. All right, so there we go. We got that example. Let's get into some more fun stuff here. This is something that Brent, myself, and Steven do all the time. So I'm going to really hit this one home. We get the drift. I don't need to keep explaining this. We changed one thing. Where did our money went first? And because of that, mine's making 6. I have this thing called Private Money Club. If any of you want to know what the Private Money Club is, it's just like eHarmony for money. Okay, if you ever were in the dating game, you probably went to eHarmony. And there was 2 profiles, guy, gal, guy, you get the drift. And then you paired it up and boom, it was done. Well, in the money world, there's always people that have money that want to make money. Me, Brent, and many of you. And there's people that need money to make money. Real estate investors, people trying to buy cars for Turo, all sorts of different things. And everybody needs money to make money. So what we do is we pair up people with money and people that need money, and we do loans, private loans. Read The Richest Man in Babylon. That's all they did back then, is lend money and make money. So this is just a better way to do it. So I'm going to take a loan. Okay, let's just, I'm going to pick on Steven. Steven comes to me and he needs a loan for $100,000 bucks. Now let's just say I got 50,000 in my policy. I can't fund a $100,000 deal. So I could either throw my arms up and be like, damn it. Well, Steven, all right, man, I'll lend to you when I have $100,000. I'm sorry, I can't do this deal. Or I could get resourceful through the Private Money Club, and I could call this guy named Brent. And I could say, hey, Brent, I got this great deal. This guy, Steven, is going to be buying this house. It's a great deal. I've done the underwriting. You should look at it. And he needs $100K. And he's going to pay us 12% to lend this money. I was wondering, can you come in at 50 and I come at 50, and we're both going to be in first lien position? We'll do a mortgage and we're both going to be on that first mortgage, 50-50 in a first lien position. And Brent says, hell yeah, man, I got to make my little green men march. So he sends his money to work with my money. So we pool the money together and we lend this $100K to Steven. We do a note and a mortgage. Okay. All done through the Private Money Club. If any of you have interest, we'll put the link up for that. Okay. Private Money Club. And then what do? Steven pays us how much? $1,000 a month. So the $1,000 a month he pays, how much goes to Brent and how much goes to me? 500 and 500. Okay, so now I got $500 coming back into my policy. Brent's got $500 coming back into his policy down here. We're both happy. Did we beat inflation? Does 12% beat inflation? Yeah, it doubles inflation. But did we just make 12% like all of you that do private lending out of somebody else's bank? No. You see, we made 12%, but we still made the spread. The spread, and the spread could be 1% on the low side year 1. And it also could be, hell, it could be 90% if you're in year 10, because every year our money is growing uninterrupted. So we could do this every year. Me and Brent could play this game every single year, every single month. We could just keep on doing this as long as we had capital in our banks. We could keep moving this money out, keep moving it, keep moving it, keep moving it, and keep beating inflation every step of the way. I don't care if inflation turns into what the 1980s were. And if any of you remember the 1980s, I'll show you in a second what that looked like. It wasn't pretty. It wasn't a very good time. Like, inflation was bad. So these are different ways where you can use the infinite banking concept to beat inflation. And I don't care what stage of the game you're at. You might be just new to this, trying to pay your debt off. I just showed you in example 1 how that would beat inflation. Okay, you might be a little further along and you might have a company and you're like, you need a little bit of seed capital, a little bit of marketing money. You need a new copy machine. Great. Be the bank, lend your company money. You might want to evolve into private lending. You see, I could play this game all day long, but I don't have time. We could keep lending and lending on different things and making more and more money. Hell, then you can get to round two and you could say, all right, all the money that Steven in this example just paid me and Brent in interest, we could just leave that money in the segregated account or move it back to the policy and then take the marching men that we made the 12% interest and send that money back out to work. You see, now we made money 1, 2, and 3 times. There is no end to this, folks. That's why it's called unlimited. Our money, every time it goes to work for us, creates offspring. Offspring are called interest, dividends, gains. Those interest, dividend gains, for those of you that aren't in the know, you spend it all. You're like, oh my God, I made 12%. Great. You go and blow it on the new Nike Air Jordans. You go and blow it on something. We don't. We take those marching men that we just made and we say, hey, where do you want to go? You want to go to work? They laugh. Yeah. Send me to work. Send me to work. All right. Let's see. I got 10 grand work. Go send it to work. It goes to work. And then it makes offspring, interest, dividends, gains. Send that to work. It's perpetual, folks. Perpetual. Now this one, pay attention. Sorry, I know this is a lot, but you know, all of you, yeah, there we go. And Chris signed his policy in 0.2 seconds. What am I waiting on? I got $1,500 a month that's going into this new policy. That money needs to go to work, Hannah. Why would I wait to sign a stupid contract that I already know what it says? I wouldn't. All right, follow this. This is kind of what I was just talking about a second ago, folks. It looks complicated. It's not. You already understand everything we just said. Let's just say you've got some tax situation and you want to run everything through your company. Jade does this. A bunch of our lenders and our friends on here do this. So we put our money into the policy. We loan the money out. We loan it to our company at a rate of 6%. You know who really does this well? Devin Burr, if any of you have ever met him. So we lend it to our company at 6%. We beat inflation already. Okay, but let's just say our company doesn't need the money. So then what we do is from our company, we lend that money out to Steven for his real estate deal. We lend that money out to Joseph for his new Turo Lamborghini he just bought that he's going to rent out. I don't know, I'm just making shit up. But now by doing it through our company, what we get the opportunity to do is make money once here on the policy, twice here by lending it to our company, and then 3 times by lending it from our company through, and we get the ability to have some additional tax deductions and taxable or tax things that we can do on this side. So now all of a sudden, when this money comes back, we could leave the money in the company and just pay ourselves back the 6%. How I do it is I do exactly that. I pay my company back 6%. But if any of you have ever read the book Profit First, what I do is I take quarterly profits from my company. So every single quarter, I pop some popcorn, I sit down and I wait for Melissa, my bookkeeper, to tell me what is our quarterly profit. And then she sends me a check every quarter for the profits of that activity. You see, I made money at what, 1, 2, 3 times, and then 4 if you count the profit. How many of you like this? Give me a hell yeah, give me a yes. Or if you guys just are lost and not even like following any of this, I get it. You probably just joined us for episode 3 of a 5-part series, so you're a little bit behind. But you see, the whole topic today was how do you move your money? How do you use the infinite banking concept to beat inflation? Well, I think I just showed you a whole bunch of ways to just do that. Can I get an amen? Anyway, probably way off topic. Here we go. How many of you think gold is a good thing to have during inflation? Well, this is actually something that Andrew actually paid for because we couldn't get the data that we needed. So we actually paid for it. The cool thing about this chart is it goes back to what I think we are going to revisit, 1929, the good old Great Depression. That's right. I think this is coming to a theater near you, and you should probably get a ticket because it's going to be a really freaking great movie. So I think the next Great Depression is coming, and it's going to come in a year of about 2022. Just my theory, but you know, production might get delayed, you know, COVID round 25.5 might hit. So we might have to push the release of this film out to 2023, but you get it. Like, we're in production for the next Great Depression. Man, I just came up with that. I kind of like that. But anyway, back during the Great Depression, I want you to look at gold. Okay, right here, 1929, gold was $319. After the Depression, what happened? The market fell out, gold went up. Okay. But that's not really a good gauge of looking at it for inflation, but this sure the hell is. How about this? Brent probably remembers the 80s. I remember the 80s. How many of you lived through the 80s when we were in hyperinflation, double digits, gas lines? You know, it was an insane time. I've read about it, and I was a young boy at the time, but I remember it was tough. Mortgages were 12%. Savings accounts paid you 10%. Who remembers those times? Jade's the only one, really? We got a young audience. There we go. Vicky and Janet, they remember that. So look at gold. Do you think gold would have been a good thing to have to hedge inflation during this period of hyperinflation? Well, by this chart, I'd say, hallelujah. Yeah, sign me up for some gold, because right there, gold would have been a great thing to have. Let's come over here. Right here, 2008, the Great Recession. Gold in 1980s was $2,300 because everybody wanted some. You ever see that movie? Everybody wants some. Yep, everybody wanted some gold. But then as the 1980s petered out and they got a hold of inflation by raising rates and doing that, gold fell because everybody rushed back into risky assets, which started the next bubble, which was the 90s. Okay, so we started pushing the 90s into the early 2000s, and we're going to skip right by this right here, which is the dot-com crash, because nobody really cares about that, but everybody should. But that was the dot-com crash. And then here, gold skyrocketed again right before 2008. And then gold fell back off when everybody started rushing back in the market. So the thing with gold is, if you're going to buy gold to hedge inflation, you better damn well hope you buy it right. Because based on this chart that I just showed you, if any of you bought gold thinking, I'm just going to buy it and hold it, unless you're a doomsdayer and you're going to actually start like cutting corners of your gold bars off to trade and barter, I get that. But if you're doing this to hedge inflation, well, it can be a risky business, because if you buy when you think you should, which is when the market's falling apart, you bought way too high. And what's going to happen? You're going to lose money, just like every other period of time. Don't do that. You should have been buying when you don't want gold, down here. Should have been buying down here when everybody else is buying, and Warren Buffett says this best, when everybody else is buying risky assets and stocks and everything else, what should you be buying? The opposite. When others are greedy, be fearful. Gold, precious metals, silver, fearful. Okay, do that. I'm just trying to get you guys thinking a little bit about what's going on out there right now. Just this only goes to 19, but right now might not be the best time to buy gold. I think the price is pretty high. That's just my opinion, but everybody can pick and choose what they want to invest in, what they want to do. And gold is, if done properly, a decent hedge against inflation. So here would be a play. Change one thing. Move your money into a privatized banking policy. If you've got rid of all those other things and you're already doing those and you got extra cash, take some of it and buy gold. How about that? Let's do both. Why have some people think, oh, well, I'm either going to do private banking or I'm going to buy gold, one or the other. Why? Do both. This is the and asset, as our friend Caleb would say. Do this, the private banking, and buy gold. Now you're making money twice. This is not complicated, folks. This is not difficult. Holy crap. Michael, your mom had rates of 18% plus. Insane. You have all heard me talk about these little buggers. Now, I hate the fact that we couldn't get data on 20 years because I don't really think 10 years are good, but I talk a lot about 20 plus year US Treasury bonds. And everybody says I'm a damn fool for even mentioning this. But let me ask you this. Here's 1980s. How many of you would want to buy these here? Okay. How many of you would be okay buying it here or here or here or here or here or here? Any of these periods of time. Do you know what these periods of time are? The time when nobody else wanted US Treasuries because everybody else was buying stocks and, well, in today's world, crypto and NFTs and everything else. So you have to do what everybody else is unwilling to do, because what will happen here is when 2008 or here's hyperinflation, the 1980s, when this happens, when the market crashes, your bonds will skyrocket because of the inverse relationship to interest rates. Not to get into that today. I'm just trying to show you some options to hedge inflation. If you're trying to hedge or beat inflation, this is not your play. I'm being honest. Do not buy treasury bonds or T-bills if you're trying to hedge inflation. Buy T-bills or treasury bonds, 20 plus or 30-year ones, only if you understand the inverse relationship to interest rates and price of bonds. And then only if you think that the next Great Depression or the next market fall is a short time away, because you will be very happy, like I was last week. When did the market drop 900? Was that this week? The market fell 900 points. You guys remember that? I think it's down today too. So one thing I want to ask is, when the market crashed the other day, did anyone just to test things, did any of you log into your TD account? Did you go on CNBC or anything else and just pull up 20 plus US Treasury bonds? Did you look at TLT? I'm just asking. Anyone look at those? What'd they do? They went through the fucking roof, excuse my language. They went nuts. Why? I just showed you why. When there's blood in the streets, when there's fear, people pile money into safe assets. These are the safest there are. Now, to sum all that up, folks, where do government or where do insurance companies put their money? Brent just showed you. Bonds. What kind of bonds? Brent, what's the number one bond in mutually owned insurance companies buy?
They buy investment grade bonds.
And another, well, what other one do they buy? They definitely buy AAA rated. They buy treasuries.
Oh, yeah.
Yeah, US Treasuries. So listen, folks, I'm just trying to paint the picture for what this is. And can I give everybody something here? How about my all seasons portfolio? Anyone want to know what I've come up with here? I think this will be really good for you. And then I'm going to wrap today's show up. Or, well, Brent's going to kind of, actually, Brent, do you have any comments on that stuff I just did? I feel like I talked forever.
Well, no, it was great. A couple things. I mean, okay, like talking about the interest rates of the 1980s. Like if you read the book by R. Nelson Nash called Becoming Your Own Banker, he talks about how he really discovered the infinite banking concept on page 12 of that book. Because he talks about how he was paying, like in the late 70s, he just got accustomed to paying 9.5%. And then came 1980, 81, 82, and the prime rate rose to 21.5%, 21.5%. Now that was the prime rate. And just as Nelson explains it, he was not a prime borrower, right? Those are those first high-class borrowers. So he had to pay 1.5% above prime. So there he sat back in the early 1980s, and he owed $500,000 in debt at 23% interest. 21.5 was the prime, and then 1.5% over that was 23%. And if you know anything about Nelson, he is a man of prayer, a man of faith, and he talks about, how he just like kind of kneeled down on his knees and he says, God, Lord, please help me find a way out of this mess. And he talks about it as it's kind of like a baseball bat that just swung across and like hit him over the forehead. And he talks about how God spoke to him and said, well, Nelson, the answer is right there in front of you. You have some of these whole life policies that you've been putting premium into for several years that you can take out a loan from the insurance company. At that time, it was like 8%. Well, 8% was great if you owed 23% on your home mortgage. So then, right. So that is really how he discovered and he put all this information together on the infinite banking concept, how having the money in the policies and being able to borrow from the insurance company by putting your money up for collateral, it helped him out of that financial nightmare that he was in. So that was a good point that you brought up, but that's on page 12 of the Black Book, Becoming Your Own Banker, if you want to read more about that. The other thing Chris mentioned was how he does it in his business, how he charges 6% because he called the bank and they were going to loan at 6.9. Let's just call it 7%. And then Chris called his accountant and said, well, okay, I mean, if they're charging 7, charge yourself 6. Well, again, that's totally fine. And that's the way Chris does it. But I would do it just a little different. I would go higher. I would charge myself 8, 9, or 10%. So more than the bank would. And here's my reasoning behind it. Now, again, guys, I'm not saying don't get crazy and charge yourself 20, but instead of going down and charging 6, I would go up and charge myself 8 to 10. Because whenever you are going to take a loan from just from yourself, there's no proctology exam that the bank is putting you through, right? Like, have you ever gone to a bank and trying to, and like, the thing is, whether you want to get a personal loan or a house mortgage, I mean, it's a pain, man. It's hard. It's like going through a proctology exam. So there's not all of that hassle. There's not all of that paperwork. So the way my mind thinks, I would rather pay a couple points more, not to have to go through all of that hassle to try to get approved for the loan. I'm not saying Chris's way is wrong or my way is right. I'm just saying it's just that we look at it a couple different ways. So yeah, Chris, I thought that was good that you went over, and I hope everybody just kind of realizes by that and what Chris went over. I hope that they see that it's all a closed system of money. There's no money being leaked out to other people. That money is all staying in your circle inside of your family. So I'll throw it back to you, Chris.
Awesome. Yeah. So, it's just so much with this topic, and people want to overcomplicate it, but you did see in that whole example we just gave, whether it's, lending to your company, lending private money, paying off debt, none of the money you made was really in those examples. I didn't focus on the policy, even though like you're going to make great money in there. And any of you that have it, what the returns are, but I focused on what your money made you by working for you more. That was intentional. I could have shown you my policies returns and you would have gotten really excited, but I wanted you to understand that the infinite banking concept is not a product. It is not a whole life. It is the process that I just showed you. It is moving your money, just like the insurance companies, just like the banks, just like the wealthy have done for decades and centuries. You just need to mimic that. If that's the case, if you do just that, inflation will never catch you. Inflation will never, ever even hurt you, but it'll hurt everybody else. Now, if you believe that inflation will be followed by deflation with a market fallout, I have built this. This is called the All Seasons Portfolio. Any of you that want this, when you set up a call with Steven, and Steven will put the link up, when you set up a call with Steven, what we will do is we will also email you this All Seasons Portfolio. But you guys can see it right here. It's very simple. Precious metals, we just talked about. Any precious metal should probably not consume more than 10% of your portfolio, your investable assets, 10%. Equities. Now, I know some of you are way over this. Some of you are like 90% equities. Oh my God, stocks have been so good. I made so much money. Oh my God, this year I'm up 40%. Good for you. Next year you'll be down 40%. Congrats. How much did you just make? A whole bunch of wasted freaking time because you got greedy. Don't be greedy. 5% in equities. That's all the All Seasons Portfolio calls for. This is not a portfolio for everybody. This is my portfolio suggestion. This is what I use. I'm a little bit on the skeptical side and nervous side of what's going on in the market, so I might be too conservative for you, but I think this works well. 40% in long-term treasuries, 20 plus year. Okay. I invest in a stock called TLT. I'm not making a suggestion or a recommendation or a stock. I'm not giving stock advice. I'm simply telling you what I invest my money in. Okay. 15% alternative investments. This can be anything. This can be private lending. Okay, this can be private investments like West Coast Income or Safari Fund, just something that's not tied to the markets. Alternatives. Okay, this could also be real estate. And then down here, and sorry I didn't do a good job coloring it in, 30% in cash. Now, I know all of you are thinking what I just said sounds absolutely ludicrous. 30% in cash. If you honestly think that I keep 30% of my money in cash, you're not paying attention, you're not listening, or maybe this is your first time. Welcome, thank you for joining us, but get around the campfire a few more times. When I reference cash, I don't keep cash in the bank. Matter of fact, my wife freaks out every single time the bank statement shows up to the house. She has a heart attack. She's like, Chris, are we in trouble? Is something wrong? I'm like, yeah, lots wrong, honey. All of our money's in our own bank, not their bank. I'm sorry. It's a big freaking problem. She understands it, but we're so trained to just look at a bank account and be like, find comfort in a big number in your bank account. I find comfort in little tiny amounts, like dangerous amounts in my regular bank account, because all my money is out moving. My money's in motion. And all my money runs through my infinite banking concept policies, the private banking policies, okay? This is where I keep probably about 30%, maybe even, I think mine's more, but my suggestion would be 30% between cash, your bank account. And here, let me give you a reference point. Some people are like, well, how much money should I keep in the bank? It's very easy. And I didn't come up with this, so I'm not the expert. How much money should be in your savings or your cash bank account? And I'm not talking about your private bank. I'm talking about their bank. 6 months and no more than this. 6 months of expenses, period. I think I'd probably keep, I don't know, maybe 2 months, but 6 months would be the suggested. You should never keep more than that in your savings or bank. Because other than that, you're just letting the bank win too much and you're losing too much. Stephen, anything that you've got?
Yeah, we just had one question I was going to read real quick, and then but I can go ahead and read this question real fast if you want to go there.
No, hit it up.
All right. So John had just said, I already have 2 IBC policies, one for him, one for his wife, that he implemented a few months ago with us. Instead of paying down my debts using the mapping you guys provide, I like to grow my real estate portfolio. My debts are all in rental income besides my student loan debts, putting 60,000 into my policies per year. Rental income is currently 7,000 to 9,000 gross per month. My goal is to increase cash flow and not necessarily pay down those debts. I want to use my policies towards real estate down payments and finance the rest of the banks to leverage for now until I'm further along down the road. Then I can transition to paying down with the banking policies if I want. Am I wrong in this thinking? So just real fast, John, my opinion, you're thinking absolutely the right way. Wow, you can take advantage and leverage your money and get these low interest rate and lock in long-term low interest rate from the banks. So no variable or anything. Lock in that 3, 4, 4.5, wherever it's at right now for rental properties, and leverage the shit out of that, because this free cheap money is not going to be around forever. But a real estate, a home, a rental property will be around forever, and that'll provide you that cash flow. So I love that strategy personally.
I'll second that.
And then anyway, I'll kind of chime in and I'll kind of just like, I agree with what Steven said too. And John, I agree with what you're thinking. I would not pay off those homes. I would not pay off those mortgages at low interest rates. I would get more money into policies, and I would get, again, which is going to increase your cash flow as time goes on, because remember, the policy only gets better with time. As a matter of fact, I'll borrow money from a bank all day long at 2, 3, 4, 5%. And I could care less if I'm paying them back interest, when I can take that same money and go put it into the investment vehicle, such as buying another piece of real estate, a hard money loan. However, that is not for everybody. You got to remember, when the bank has those loans, then they are in control. So it depends on where you're at in your mindset and how disciplined you are with money. So I'm going to assume, John, that you're disciplined with money and that you're good with money, but just know that if things just come up, or there is a problem, or there's trouble, or you have financial difficulty, the bank does not care. They don't care about your problems. They don't care if it's too cold outside to work, too hot outside. They don't care if you are sick, if you have COVID or not have COVID. They could care less about that. They want their money when they want it. So remember, the bank is in control when you owe them money. But if you're disciplined, it's okay. You can work around that. Now, I tell people this all the time. I have clients that are extremely disciplined with money. So yes, you should use other people's money, right? So if that's the way you are, but then I have clients that they think just because they have checks left, there's still money in the bank, right? So that would not be a good idea for them, because every time they get $1, they spend $1.10. So it depends on where you're at and what your mindset is about money, and mainly like how structured and disciplined that you are. But yes, the overall answer is I want to use other people's money at a low interest rate environment.
Yeah, and I think that's well said. And John, I think you're doing all the right things, but I would second what Brent said. I mean, one of the things we always want to do is pay off all the debt, because that's what Dave Ramsey always says, have zero debt. You don't want any debt. But one of the things you have to understand is, if you can make your money go to work for you, like I just showed, at 12%, why would you not just take the money that you'd pay off a mortgage, at 3%, Why would you pay off 3% when you can take the money from paying the mortgage off, send it out to work for you at 12%, then take the 12% that you're making, the interest, remember it's children, and send the children back to pay down the mortgage. It just seems like a much more efficient way. And, you know, if any of you are not car people, I get this. And I never talk about my cars, only recently because I'm showing concepts of how I'm doing things. But I've always been a car guy. I grew up not having nice cars. And when I had the means to get cars, I was an Audi freak. And, you know, now I love cars. But I buy cars very different than most of you, because I've learned something that all of you are either in the process of learning by being here, or that you're already learning it. You're just kind of starting to dip your toes in and really, you know, figure this out. Because no matter what kind of car I buy, I know how to get all the money back for all of the car. So it doesn't matter what I buy, right? I just recently had a G-Wagon. It's a pretty fancy freaking useless vehicle, but they're cool. But I sold it because I made money. And just like Warren Buffett says, buy low. I did. I bought it right at the beginning of COVID, before all this crazy stuff happened. I got it really cheap. And then a friend of mine said, hey, you want to sell your G-Wagon? I'm like, yeah, but you're not going to like the price. I threw a price and he bought it. And I ended up making $10,000. I mean, I've never driven a car for a year and a half and then sold it and made money on it. I just haven't. But I didn't just make money by selling it. That's the easy thing. All of you can do that. But no matter whether I sold it or kept it, I would have got all the money back for the G-Wagon anyway. My wife, we bought her a Porsche. Some of you saw the training. It was a beautiful, all blacked out Cayenne S hybrid. Beautiful car, you know, and I bought it with my private banking. I tell the story all the time of how I walked into the dealership. And I literally had them figure out all the financing and going back and forth with the finance manager. Finally, they pushed the paper across the thing. It said $980. I'm like, yeah, this is great. We'll take it. And he's like, all right, we'll get all the paperwork ready. And then he slides me over finance paperwork to buy the car. I'm like, I don't need this. And he's like, what do you mean? And we just went back and forth trying to get to the best rate. I said, yeah, because instead of me wasting time, I figured you could just figure out how much I should pay my bank back. I still make that $980 payment every single month back to my policy every month. And I've been doing that for now over 2 years with that car. But I walked into, and this is a weird one, a Maserati dealership with my wife. And they had just gotten in a brand new 2022 Maserati Levante. It's a different kind of car, not something that I'd always liked, but it's all blacked out. It's got a really cool package. And, you know, we ran the numbers, and the payment on this stupid car, if I was to finance it through a bank called M&T Bank, would have been $1,758. Ouch. Now that sucks. But see, here's the thing. I said to myself, and I said to my wife, I said, listen, I don't need this car. I don't really want this car. I think it'd be awesome. But if I can get them to give me $50,000 for this Porsche, okay, which was more than I could sell the Porsche for, and I knew it would go, when the market falls out, I probably only get 40 for the Porsche. So if he'll give me 50, I'll buy this car. I have the money in my banking policies to fund the difference. So what I just want to show you, and you guys can believe this or not believe this, it doesn't matter to me how you look at this, but what I'm going to do, and I'm going to make my screen the big screen here. I think, there we go. What I'm going to do is I'm going to pencil this out, and I want all of you to understand that this didn't happen overnight. I've had these policies for years. I've been being my own banker for years. I've been moving money through these policies for years. So I have the money, right? This money didn't just drop in my lap. I didn't get a windfall of money. I just had enough money in my policies because of activity to use to buy this car. So let me just show you the numbers, because what I'm going to show you, and I want you to all listen very closely. I'm going to do a YouTube video if you missed this. I bought this Maserati, and my cost for this Maserati, after I show you how I did this, is going to be $8,782. So how many of you, and you guys can chat this in, how many of you would want to buy, and whether it's a Maserati or whatever car you like, buy a new car, a 2022 luxury car for $8,782? You guys want to know how to do that? Yeah, okay. Well, it's actually pretty simple. So let me pencil this out. So first off, we got to talk about, I had a car. So we had a Porsche, and I got $50,500 for trade-in for a 2017 Porsche. Okay. So that's where I started. I already had this car. This car was already financed through my private banking. So I have equity. Technically, I own the car. It's just the only debt is to my policy. So the Maserati that I bought is $91,206. Now, I don't know about any of you, like, I don't care how much money you have, like that one takes your breath away a little bit. Anyone else like kind of gasp a little bit? Because I did. Told me that, I'm like, holy shit. First thing I thought is that car's $91,000. That thing should be 70, but that wasn't the only, I'm just like, man, cars are expensive these days. They really are. So that's the cost of the car. But see, the way we buy cars, and because we have a good CPA, I understand another little thing. And that is, I understand what a 179 deduction is. So now real quick, can anyone tell me in the chat what a 179 deduction is? Does everybody understand what a 179 deduction is? Because I'm just going to show you, like, there's this thing that some of you, and I say this all the time, so you're probably getting sick of hearing it, but there's this thing that we all know about called Google. And all you need to do is just go into Google and type in, what is a 179 deduction? All I did to get to this calculator is I typed into the Google search. I said 179 deduction calculator. Whoa, that's a tough one. And boom, it pops up. So what this is a 179 deduction is a deduction that's allowed on equipment. And this has to be for a business use. So there's the price of my car, $91,206, okay? Tax bracket, I mean, I don't know. They didn't really give me where I think I am. So I'm just guessing I'm at a 35% tax bracket, but it doesn't matter, but we'll use that. Boom, 2 entries. I hit calculate. There's my number. My deduction on this car is $91,000. So that I can deduct the full amount of the car, depreciated, whatever you want to call it, but it's a deduction. And the only reason I can deduct this, and here's the rules, is because my vehicle weighs over 6,000 pounds. Okay, your car has to be over 6,000 pounds, or your truck. F-150s are over 6,000. That's why Brent has one. Most millionaires have an F-150. Why? Because they're over 6,000 pounds and they understand this little tax loophole. So here's my tax savings based on my tax bracket, $31,922.10. So technically the net cost of my vehicle after I get this deduction is $59,283. All right, so now let's pencil this thing out. If this is what it's going to cost me, but then what I got is I get a deduction, okay, for the full amount of $191,206, which gives me at a 35% tax bracket. That's just an estimate. It gives me roughly a $31,922, and I believe that's 10 cents. That's my tax savings. So if we just take this 91 minus, because this is like putting money in your pocket. I don't know how you guys look at tax deductions or tax savings, but that is money that I either get to keep or I got to give away to Uncle Sam. Just want to be clear about that. So $31,922.10. If we do the math, that means that my car, this new Maserati, would still have a hefty price tag of $59,283.90. Okay, so that would be the amount I'd have to pay for it. But I already told you I have a Porsche to trade in, and they gave me every penny, including 500. I don't know why he gave me an extra 500 over. I guess he was trying to be an overachiever. So he gave me $50,500 for my vehicle. Okay, this is the trade-in. So the net cost to me to buy this vehicle after I take my 179 deduction in the tax savings is exactly $8,782. But here's where the thing gets really fun. All of this entire thing, this whole little dog and pony show of how I buy cars or how I bought this one, all comes down to one other thing. This is being financed by my bank. My private bank is paying for this. My private bank paid for the Porsche. My private bank will pay for the difference of what's owed on the Maserati. And I legitimately, like clockwork, will set up a monthly bill pay for $1,700, and that still hurts me to even say it, $1,758 every single month. But here's the thing. How many of you, and I got to see the chat because I got to ask this. How many of you would freak the F out if your husband or wife came home and said, honey, look at the car I just bought. It's $1,758 a month. How many of you say aye? Because I would. I'd freaking say, honey, we have to go have counseling, right? But so there we go. I'm just going to let you guys kind of keep saying that, right? All of you would freak out. But now let me just change the dynamic of that. You come home with a brand new car and you say to your husband or your wife, or say, honey, sweetie, we're going to save an extra $1,758 in our banking policy. And oh, by the way, look at the car that's in the driveway. How many of you would be okay with that? I love that. Teresa's like, to the curb. Now, how many of you would be okay with that one? Honey, we're going to put $1,758 extra every month into our bank. Oh, and by the way, look at the car in the driveway. Isn't that nice? Do you understand? It's the same freaking thing. I didn't change anything except for one thing, folks, where my money went first, which is exactly why I'm telling you, all of you, you need to do this. This should not be an option. This should not be something that requires thought. This should not be something that we have to take phone calls and emails about, hey, this illustration, I was thinking it was going to have a little bit more money up front. Like, do you not understand what I just showed you? I don't care if, and also just so all of you know, this banking policy that, well, it's a series of banking policies, but my banking policies that bought this, they are not the high early cash value ones. That's right. They are the plain Jane, old fashioned 60-40 design that I only had about 60 to 65% available year one. That's right. So that's all we had in the beginning. My new plans are the high early cash value ones, but I lend that money out. Like, this is reality, folks. Buying cars is a whole different dynamic for me, for Brent, for Steven, for any of us that understand this, because it's not buying a car, really. It is, but it's moving your money and just saving more money, because every penny of this comes back to me every month. But here's the shitty part. The first thing that had to happen for all of this is I had to have my bank capitalized up to $91,000. Now, I know many of you aren't there yet, but you will be. That's the good news. I'm not bragging. I've just been at this longer than you. That's all there is to this. All right, Steven, Brent, anything you want to comment on that?
Yeah, no, man, good stuff. So just three things that came to my mind. Number one is, why in the hell did you take your wife Larissa to the Maserati dealer, would be question number one. I know your wife, and I know
we were arguing, and I thought that would end the argument.
That's like, that's like her. So anyway, so that's like taking her to the cat store and petting all the cats, right? You know she's going to come home with some because she loves cats. and then let's see, I wrote down something else too. Oh, and then so number two, I didn't know you were getting rid of the G-Wagon, man. I love the G-Wagon.
I know, so did I. It was my favorite vehicle I've ever had.
I wish you would have called me before you sold the G-Wagon. I didn't know you were getting rid of it.
It wasn't a planned thing. It was just sporadic.
And then the third thing is, I don't know a lot about Maseratis, but just be prepared. I had actually, so I have a client. Their name is Dave and Yvette.
Yeah.
They, okay. And anyway, so my daughter Hannah knows Dave and Yvette. Anyway, so they had a Maserati. He called me up one day and he told me how much it was to get an oil change in one of those things. I was like, no, Dave, I thought you were just getting an oil change, not buying a new used car.
I policy just for the maintenance.
I should have asked.
What's that?
You need a policy just for the maintenance.
Holy crap. Yeah. I guess if I bought
But it's okay because like you said, all that money's going to be recaptured back.
Well, yeah, maybe I just won't change the oil.
Brent owns a twin engine airplane. He's talking about maintenance costs.
Yeah, exactly. Oh man.
Stuff. I was wanting to kind of go over two main topics today about how a policy actually works. And all right, so how buying a policy is like starting a business from scratch. So let's talk about how buying a policy is like starting a brand new business from scratch. So if I told you that the thing is that, let's say, for example, that so there was an opportunity, and the thing that, and on this opportunity, you are going to start a brand new business from scratch. And this is how the business was going to perform. Totally guaranteed. This is how your business was going to perform. So I'm going to ask you, how many of these businesses would you want to own? But I don't want you to answer yet, because I'm going to show you how the business works. So if I had an opportunity for you and I said, look, here's what you can do, is go into business, and this is how your business is going to work. The thing that you're going to do in the very first year of the business, you are going to put in $1. into that business. All right. That's how much you're going to put in, is $1 into the business. And at the end of the year, okay, the thing you're going to do is pay all the overhead, all the cost, everything of the business, and you are going to walk away with 55 cents. All right. Now, I know what you're thinking. You're thinking, all right, well, I put in $1. I paid all the expenses, the business, okay, like all the overhead, all the expenses, and I still walked away with 55 cents of that dollar that I put in. You're probably thinking, well, that's not the type of business, right, so that I want to be in forever, but I know it's a brand new business and I had to start it. I had to get it off of the ground. It's like if you fly an airplane, right? So the majority of the fuel is burned by like just going fast down the runway and trying to get it off of the ground and into the air. So now the thing we do is we go into the second year of the business, in year 2. And Chris is going to write up there year 2. And now I'm going to put another $1 into that business. That's what I'm going to contribute into the business. And again, I'm going to pay all the overhead, all the taxes, the employees. I'm going to like all the taxes, the insurance, everything that goes along with the business. And at the end of the second year, I'm going to now have a total of 65 cents that I can take out of that business. And you're thinking to yourself, well, not exactly where I want to be. However, it's better than year 1. So I'm moving in the right direction. All right. Now, remember, this business is going to last you your whole life. And I want you to be thinking, how many of these businesses do you want? Now we're going to go to year 3. We're going to do the same thing. We have to inject $1 into the business. But now, after paying all the expenses, all the overhead, everything that goes with the cost of running this business, you now have 95 cents. Now you're thinking, wow, now we're getting somewhere. It's not exactly where I want to be yet, but I know it's right. It's just still a new business, and it's going up and increasing every single year. So at this rate, it's only going to continue to get better. So I'm going to like stay in business for sure. I'm not getting out of business because it's going in the right direction. I put some time, energy, and dollars into the business. And now we get to year 4. And now in year 4, we put in another $1 into that business. And now we pay all the overhead, all the expenses, all the costs. We pay the employees, we pay for their vacation, we cut the grass, we pay the taxes, the insurance, every cost associated with that business. And now what do we have to use? We have $1.05, $1.05 to use. Now we've now turned the headwind into a tailwind, have we not? So now we're getting more from the business than what we're putting in. Now, this is the way the business is going to continue. Every single year, when we put in $1 to that business, it's going to give us a greater number every year. So, for example, in year 5, it may give us $1.12. In year 6, it may give us $1.25. In year 7, it may give us $1.45. I will tell you, in my business, in year 13, every $1 I put in, it gave me $2.09 to use after I paid all the costs and the expenses of that business. Now, if this was true, and this was a business that you could get into, and this was guaranteed the way that it was going to work, no ifs, ands, or buts about it. It doesn't matter what's going on in the external environment. It doesn't matter if there's a pandemic. It doesn't matter if there's riots or protests. It doesn't matter if the real estate market goes up or down, the stock market goes up or down. It doesn't matter if you're a Republican or a Democrat, you love Trump, you hate Trump. All that stuff doesn't matter. This is the way that your business is going to perform, and it's going to perform this way each and every year for the rest of your life. And the longer it goes, okay, the numbers just continue to get bigger. If this was a true statement, and this is exactly how a business was going to work, and you had the opportunity to get in that business, how many of these would you want to own? Well, I'm hoping the correct answer is as many as possible. And this, ladies and gentlemen, boys and girls, this is exactly what you're doing when you start a specifically designed, specially engineered whole life insurance policy in a mutual company that pays dividends. You're essentially starting a brand new business from scratch. Now, get this, because the news even gets better. In this business, this is a business that doesn't have to be like just overseen or managed on a daily basis. It doesn't have employees. It doesn't have people calling in sick, people asking for vacation, people whining and bitching about their hours. No, this is a business that's going to run on its own. And as long as you give it 20 to 30 minutes just of attention every 3 to 4 months, the business is going to continue to flourish exactly the way that I'm showing you. Now, there's ways in the business that it could even be more profitable. And how would that be? That would be borrowing money from the business and paying back with interest the same way you would pay a bank back, right? The numbers would only get bigger because this is just the raw form of the business. It's just there. You bought the business and you're letting it sit. Now, as I said, on this business, it has no overhead. It has no employees. It has no grass to cut. It has no toilets to plunge. No, this is a business that is going to run on its own, whether you give it attention or whether you don't give it attention. And on top of that, as I said, the business gets better each and every day. Today's better than yesterday. Tomorrow's better than today. That's not me telling you. That is inside of the contract of this business. Now, let's say, okay, so as I said before, so this business is going to go on until you die. And at the time of your death, this business is going to be sold, all right? Now, or actually, I shouldn't say sold, it's going to go away, it's going to diminish. But guess what's going to happen at the time of your death? There's going to be just like an astonishing number that is going to get paid out to your beneficiaries at the time of your death when this business stops. And that money is going to go to your beneficiaries tax-free. And so here's exactly what I mean about that. So, okay, so like I said, this business has no employees. It's going to run on its own. So, all right, so like probably a couple of you are thinking, I have the real pessimistic mindset, and you're thinking, well, Brent, this is all fine and dandy, but how about if I die early and I start this business? Well, so let me answer that. If the insurance company thought you were going to die early, they would never allow you to start this business. So they don't think you're going to die early, but it's possible. So, all right, so it is possible that you could. So let's just say that you died, say, I don't know, let's call it like 2.5 years after you start the business in month 30. So now what happens in month 30, like 2.5 years later? Now I know what you're thinking. You're thinking, well, Brent, I put in $1 into this business in the first year, and I could only use 55 cents of that dollar. All right. And then I put in $1 in the second year, and I could only use 65 cents of that dollar, and now I die. So now you're thinking, oh my goodness, I put in $2 into the business and I can only use $1.20 of what I put in, right? Because 55 plus 65 is $1.20. So you're saying, well, that sucks. I died. I put in $2 and I can only use $1.20. Well, is that really true? No, because what happens at the time of your death? What happens is there's this thing called a death benefit. And that death benefit is going to be way, way, way greater than the $2 that you put in. Okay. So now what's going to happen is that death benefit, let's just call it $10 for easy math. It could be a little less, could be a lot more. Okay. But let's call it $10. So now you've got this 2-year-old business. You died early. You put in $2, but now that you died, there's $10 that's going to get paid out. Okay. They've already given you $1.20 of the 10. So the additional $8.80 is going to go to your beneficiaries tax-free, and the government's completely out of your hair. So how cool would that be? No, I know it's not cool to die in the second year. That's not what I mean. But how cool would it be to know that you have a business model and this is the way that it works? And you don't really have to spend any time, energy, or overhead into the business. So I'll ask you again, how many of these businesses do you want to own? And I hope the answer is as many as possible. This is exactly what's happening when you start a specifically designed, specially engineered whole life policy at a mutual company that pays dividends. Now do you see why, out of the over 4,000 clients that we work with in every state of the country, that 91% of those that have been with us a year or longer come back and buy additional policies, or for a lack of another word, start another business? And of those 91%, we have 70% that come back before the first year is even up. Do you see why? Because see, so the more you understand what is going on in the financial world, the more you'll know what to do. And this is what we do all day long. We help and serve people by creating your own specific business that works just like this. So I will tell you, the very first time I heard this was like a huge paradigm shift for me, because I often thought in the past that I'm spending money to pay premium. I'm spending money to pay premium. Oh my gosh, the premium's due. I got to pay premium on my life insurance policy. Now every time I open up the mailbox and it says premium due, I'm dancing around in my Speedos, man, because I'm excited. I'm excited to pay that premium because I know my business is 1 year more older. It's 1 more year efficient, and the numbers just keep getting bigger. It doesn't matter what's going on in the external world. This is the way that it works. And when you take this concept that I just shared with you and you apply it to the stuff that you're doing in life anyway, all the stuff that you're buying, your cars, your boats, your airplanes, your houses, everything that you're buying, your charitable giving, your taxes, and you run that money through a policy and you're recycling and recapturing the policy, not only do you get the money that you put in, your capital contribution, as Chris called it, but now you get the money back, plus you get so much more. And there's no wealth that's exiting your family at all. That wealth is staying in your family under your control. There's no money that's being leaked out to other people. There you go, Chris.
Very cool. Very cool. All right. So that was a great, not the artwork, but the description of that was awesome. So let me just get this up. And then do you want to, I know Hannah wanted us to create this because a lot of people get hung up in the design. They watch videos and 40, 60, 90, 10, all these different things. And they're really getting themselves just, down a rabbit hole that isn't important because they're losing sight of why they're doing this. And they're so thinking that it's all about the whole life policy. And that's the only thing that matters. And it couldn't be further from the truth. So Hannah had us build this. So do you want to just take a second and explain how these actually work?
I do. There is a place to store wealth that can be accumulated and stored that does not engage in lending money that does not exist. It has been around for over 200 years and it is widely accepted. There are millions of people who participate in the practice. It is called whole life insurance policies that pay dividends in a mutual company, one that is owned by its policyholders. There are no stockholders. No, there's no stockholders. It is a mutual company, so you own the contract. So the life insurance policy owners pay premiums to the mutual life insurance company. In other words, they buy life insurance. This forms a large pool of money. So that, right, you see that right there in the center. That is the money pool, okay? This pool of money is now the property of the life insurance company. It is not the property of the policy owner, okay? Go back to the quote I just read by Ludwig von Mises as many times as necessary until you completely understand that. So there's a large pool of money. It doesn't matter if it's the American dollar. It doesn't matter if it's the Mexican peso. It doesn't matter if it's the yen, the denali, whatever it is, whatever currency it is, there is only one pool of money. So to be able to pay the guaranteed amount of death benefit that the insurance company is guaranteeing you that it will pay out on your death, it's not an if you die, pass, or graduate, it's a when. But in order to be able to pay the guaranteed death benefit, the company the company has agreed to pay, then the company must put this pool of money to work by making investments. And how do they make those investments? Well, look at 1, 2, and 3. 1, 2, and 3. They make investments to the policy owners. They make investments to mortgages and joint ventures. Now, I want you to take a look at the joint ventures, okay? The joint ventures is where they're probably putting least amount of their money because it's a higher risk. For example, a joint venture would be something like a strip mall, right? Maybe they're putting money into a strip mall, and possibly the strip mall could go out of business or could go under. However, normally that doesn't happen for some time, and the banks have already recouped all, or actually, so like most, if not all, of the principal and interest. Okay, so joint ventures is where insurance companies can put their money. Also, they can put their money in what you see number 2. Investments that have a lesser risk are businesses and residential mortgages. This type of activity it actually ranks number 2. There are conventional mortgages, basically 20% down, right? Like conservative loans, not the subprime crap. No, not the subprime loans. Okay. So then every month, the borrower does what? The borrower makes a payment. So the strength of the lender increases. The borrower is who? The borrower is the commercial mortgages, right? Where Chris said they have a first secured position. The commercial or the home mortgages. And every month, as that payment is getting made back, then it becomes bigger and better because now the business of the insurance company increases. So the strength of the insurance company or the lender increases. The borrower owes less and less, and the lender has a mortgage on the entire amount. That's key to understand. So just because, let's say you buy a house for $500,000 and you put 20% down, which is $100,000. Well, the whole mortgage is 500 grand, right? Well, as you're paying down the principal, as you pay it down to 300, the bank is in a better position. As you pay it down to 200, the bank is in a better position. As you pay it down to 100, the bank is a better position because they still own the mortgage on the $500,000 piece of property that you bought. So if you default, they're going to own the property. Even if you own 100 grand on that $500,000 piece of property, they own the property, right? They own the mortgage. So they're going to get all of their money. So yes, you always want to be in first secured position, in my opinion. And a lot of what we do in the banking concept, right? People of us that own policies, we make these kind of loans. For example, if that's something you're interested in or want to learn more about, you should probably get with Chris Naugle and Stephen Nagy about the Private Money Club and see what they're doing in the Private Money Club. Well, how are people lending money to other people in the Private Money Club? Well, generally, they're putting their money in their policy first, and then from the policy, they're making a loan, right? So again, get with Chris and Stephen about that. And then the third thing that comes with the least risk is number 1, okay? Number 1, which is what? Is going to be policy owners. Now, turn your attention to number 1 in the diagram, policy owners. The insurance company will lend money to them up to the amount of equity each person has in the policy. In other words, the cash value at any particular time. That is 100% of whatever can be lent from that owner's policy value. The owner of the policy, which is you generally, the owner is now using the cash value as collateral to obtain a loan from the insurance company, which now holds a lien against any potential death benefit. Okay, because at the time of death, then the death benefit has to get paid to the beneficiary. But what has to get paid off first? Because who's in number one position? The policy loan has to be paid off. So for example, if your death benefit is $1 million, and let's say you've borrowed out $300,000, now at the time of your death, yes, the death benefit is still $1 million, but they've already given you $300,000 while you're living. So the policy loan of $300 will get paid off, and the additional $700 will go to your beneficiary's tax-free. All right. There is some, though rather small, risk in the other investments that the insurance company makes. For example, number 2 and number 3. There is some risk. However, it is low risk because the insurance company is not going out and doing high risk investments, right? About 80% of their portfolio is investment grade bonds. However, in number 1, the loans to the policy owners, the loans to the policy holders, however, are totally secure. Thus, it is obvious that the owner outranks every other possible borrower in access to money. So the cash value in this policy that the insurance company must put to work in order to be able to pay the promised death benefit. And even more, the insurance company cannot lend out money that doesn't exist the way a local commercial bank does. Hence, they cannot inflate the money supply. What in the hell is going on right now in our environment? What's happening to inflation, right? Insurance companies cannot do that. Go back to Austrian economics. $1 has to protect $1. So since that is true, a policy owner can borrow up to 100% of whatever can be lent from his policy at any point in time. Then this means that the owner has absolute and total control. Isn't that what we want? Total control. The owner has absolute and total control over the lending function of the insurance company as it relates to the equity in his policy. In essence, the policy owner is saying to the company, I don't have any use for the money right now, so go put the money to work in all those other avenues. For example, number 2 and number 3. But at any time, the policy owner comes knocking on the door. They come knocking on the door and saying, hey, I want my money. I need to borrow my money. The insurance company has to come up with that money. They have to come up with that money. They may have to sell off some investments. They may have to take the money from new premium that's coming in. But when the insurance company comes knocking on the door, when the policy owner comes knocking on the door, the insurance company has to provide. Anyway, okay, Chris, I think that's good. I just want to make one other point right now, is that a loan is an asset to a bank. Now that sounds a little bit strange, doesn't it? A loan is an asset to a bank because every time we think of the word loan, guess what we think of it as? A payment, a debt, an expense, a liability. Well, see, every time me and you are, all right, so every time we are going to put money into the bank, that money becomes a liability of the bank, does it not? It does, because the banks owe you interest on that money you just put there. Well, how does a bank make money? Right? So how does a bank make money? Loans. They loan money to you and me and other people. So a loan is an asset to a bank. So like, isn't it strange that a bank thinks of a loan as an asset, but we think of it as a debt, expense, payment, liability? We have to start thinking of a loan as an asset, because really that's what we're doing in our life, right? All we're doing, and again, guys, I'll just take you back to the example in the 90-minute presentation where the bank is in the middle, and then you got someone borrowing out for a home mortgage, a car loan, a house remodel, credit card debt. All of that stuff is being done in our life. We are constantly moving money in those directions. So we want to be the bank. We want to be the banker in our life. We want to control the banking system where there's no money being leaked out whatsoever. So every time now that you think of a loan, when you take out a loan from your policy, you want to think of it as an asset because you're taking that loan out probably to put it into something that's going to give you additional money. Are you not? With all that in mind, so now I want to take a look at the activities that are going on in a whole life policy in a mutual company that pays dividends. So isn't it obvious that the insurance company must put lots of money to work in various places in order to be able to pay the death benefit, regardless of when the insured dies? Also, isn't it obvious that the policy owner outranks everyone in access to the pool of money, his equity in that policy? That must be lent. Isn't it obvious too that your need for financing the things of life is greater during your lifetime than your need for death benefit? Let me repeat that again. Isn't it obvious that your need for financing the things of life is greater during your lifetime than your need for death benefit? This is not true with term life insurance. It's not true with index, variable, universal life policies. Okay. This is a specifically designed, specially engineered whole life policy in a mutual company that pays dividends. Therefore, the insurance company does not have to collect much premium in order to pay the death benefit for those who do happen to die during the limited time frame. So Nelson Nash says, instead of calling this a whole life insurance policy, if it was up to him, he would have named it a personal warehouse of wealth system with a death benefit as a bonus. Think about that. A personal warehouse of wealth system with a death benefit as a bonus.
All right, if you like that video, make sure you check out this video right now. And also don't forget, subscribe to my channel and don't ever forget to smash that alert button. We'll see you on the next one.